Hello, welcome to Investing&Trading.com. Today we will discuss about how to trade our Forex signals, the difference between the fixed lot size and the fixed amount. There are two types of signal providers. The first one is a pip hunters who target the number of pips, and the second one is a risk reward ratio hunters who are mainly concentrating on the risk reward ratio rather than the pips. So we are the pip hunters. We are concentrating mainly on hunting down the pips. Every week we have a target and every month we have a target. So we are trying to achieve those pip targets and not risk reward ratio targets. Now, what does that mean to a signal follower? So what is the difference it makes? So our target is to achieve 600 to 1000 pips every month, and we follow a risk reward ratio of 1:1.5 to 1:2 to achieve our goal for the month. We are not much interested in a risk reward ratio trades of 1:4 or 1:6, unlike the risk reward ratio hunters. So this means that the followers should use fixed lot sizes as risk management and not fixed percentage of capital. To detail it in further, let us consider 5 trades. We have 5 different trades where we have certain losses and certain profits. So the first trade is having a stop loss of 25 pip and a take profit of 40 pip, and the risk reward ratio is 1:6, and consider that was a loss. And the second one is having a stop loss of 70 pip, take profit of 100 pip, a risk reward ratio of 1.5, and we have achieved the target. Third one is 35 pip, stop loss 70 pip, take profit, a risk reward ratio of 2, but eventually went in loss. And the fourth one, 40 pip, stop loss 80 pip target, we have a risk reward ratio of 1:2, also went in loss. And the fifth one, we have a stop loss of 65 pip, a take profit of 110 with a risk reward ratio of 1:1.7, reach our target. So these 5 trades we have lost 3 and won 2. So if you look at the total trades, the trades won is 2 trades, the trades lost are 3 trades. The total pips won is 210 pips, that is 100 and 110, and the total pips lost is 100 pips. So if you tally together, you can see 210 pips won and 100 pips lost. So eventually we ended up with 110 pips in profit. So even though the accuracy of the trades is not that great, we can say that we are still in profit in matter of pips, because we have won 110 pips. Now let us analyze these 5 trades based on 2 criteria. The first one is based on fixed lot size, and the second one is based on fixed percentage of risk. Based on the fixed lot size, so let us assume the trading capital is $1,000 and consider a risk of 5%. So the lot size for 5% risk is equal to 0.05 lot. So which means this lot size has to be considered fixed for all our trades. So that is a concept. We will be keeping the same lot size for all the trades that we take. So we are analyzing the 5 trades. So lot size for all trades to be dealt with 0.05 lot size. So the trade 1 is in loss 25 pips with a lot size of 0.05. We will lose minus 12.5. So second trade we are in profit 100 pips with a lot size of 0.05. We get $50. Third trade is minus 35 pip and we lose minus 17.5. Fourth trade we lose minus 20, and the fifth trade we get $55. So if you tally it up, we can see that we get $55 altogether from all the 5 trades, so which is basically a 5.5% return on investment of $1,000. Now let us analyze it based on the second concept, that is based on the fixed percentage of risk or fixed percentage of amount. So trading capital is again $1,000, considering a risk of 5% every trade. So which means we are risking 5% of your capital on every trade. So 5% of $1,000 is equal to $50. So every trade we risk $50. So our stop loss, if hit, we will lose $50 on every trade. So the lot sizes for 5% risk, it will vary based on the pips, because if it is 25 pip, then to lose $50 we will have to have a certain lot size where considering against a 100 pip stop loss. So we will have a review based on these different stop losses in the next slide. Let us take the trade 1. The trade 1, we have a stop loss of 25 pips. So our risk in this trade is $50. That is based on a fixed percentage of capital. So risk equal to 25 pips into 0.20 lots, that is $50. So the lot size we will be using for this trade will be 0.2. That's how we end up on a $50 risk. But for the second trade, if you see, our stop loss is 70, so we will have a smaller lot size for the second trade. And for the third trade, if you see, the stop loss is 35 pip, so we will have a different lot size to ensure we are risking $50 on that trade. So against our fixed lot size of 0.05 in our first concept, here we are considering a different lot size for every different trade. So the risk same amount and not fixed lot. So that is a difference here. In our first concept we are risking a fixed lot size, where here we are risking a fixed amount. So let us analyze these trades based on the second concept. So the trade 1 is minus 25 pips, and with a lot size of 0.20 we lost $50. On the trade 2 we got $100 profit, but the lot size is smaller and we received only $70. Trade 3 we lost 35 pips, but with a lot size of 0.14 we lost $50. And on trade 4 again we lost 40 pips, and with a lot size of 0.12 we lost again $50. But on the trade 5 we got 110 pips, but the lot size is smaller, 0.08, because our stop loss was 65 pips. So we had to take smaller lot size to ensure the stop loss is only $50. So we received only $85. even though we are in profit. So altogether, if you tally it up, we can see that we have received only $5 with this method, which is equal to 0.5% of return of investment, considering against a $55 in our first method. So the final result is, with a fixed lot size, we were able to achieve 5.5% return on investment, whereas with the fixed risk percentage of the capital, we receive only 0.5% on return on investment. So this is why we say, as pip hunting signal provider, we advise all our followers to consider a fixed lot size to trade rather than a fixed percentage of your capital. We consider only fixed lot size, at least for a month. For a month you consider the same lot size, and if your capital has increased, then you can update your lot size so that to trade for the next month. So let's see if this pip hunting method is worth it. Is our signals worth following? Since November 2022 till April 2023, when the video is made, we have hunted down more than 4,800 pips, which is, if you are risking 5% of lot size, so we will be at a 240% return on investment. So we advise to use 5% lot size, but even if you risk between 8 to 10% lot size is also good, because we don't clutter our group with a lot of signals. We basically provide around 5 to 6 signals in a week. So one signal is given, normally we will wait for that signal to complete to go for the next signal. So even a 5 to 10 risk is also considerable with our signal group.